Hmm. Hey, early birds, how you doing? We'll be kicking off in just 2 more minutes here. So bear with me as I get us all queued up. So maybe if you wouldn't mind just confirming that you guys can hear me all right and that my audio is coming through loud and clear, that would be appreciated. And I'm just going to get us live on Facebook and then we'll kick off. And boom, we are live. I guess I just need to share my screen with you guys and we can kick off. And let me just confirm. Awesome. Thank you guys for confirming that that you can hear my audio and that chat is disabled. I didn't know the chat was disabled. We may have to look into that in a future session because I want to just dive right into things. So today's session, as you know, is top 10 advanced tax strategies for corporations. Hopefully you guys are going to find this informative and walk away with some tangible strategies that you can use to help pay less tax. We'll start with a little bit of housekeeping. I was going to mention that if you have any questions throughout the session, you can post those in the Q&A, which we will be looking at first. I was also going to say you can post comments in the chat, but apparently you can't post comments in the chat right now. If you are watching live on Facebook, and I see there are a few of you here joining us, you can post your questions right in Facebook and we'll make sure that we copy those over to our Zoom session and answer those queries live. Of course, those of you that are here live with us, and we do have almost 50 people registered for this session today. If you are live with us today, you can post your questions in the Q&A as well as raise your hand. Raising your hand will allow me to open your mic so that you can ask a question verbally if you find it easier, as sometimes chat can be difficult to convey your messaging. So again, without further ado, our session today is on the top 10 tax strategies to help small business owners. For those of you who aren't familiar with our organization, our company name is CPA4IT, and our mission is to help small business owners organize their finances, create wealth, and transform wealth into a legacy. We've been doing that for over 4 decades now. The firm was founded by my father, George Wall, and we've been specializing in IT consultants and service-based professionals since those early days in 1984. And we are one of the few accounting firms that are ISO 9001 registered, which simply means we have systems and processes that are externally audited and designed for constant and never-ending improvement. We've also won a number of awards, including top 50 cloud accountants, top 100 accounting influencers. We're also an elite QuickBooks Pro advisor. And all of that is just to sort of demonstrate our knowledge and expertise in this field. Now, in today's session, we're going to be flying through some of these topics relatively quickly. As I said, you can ask questions throughout, but on some of these topics, we do dive further and deeper in other sessions that we host throughout the year. We've just done some with our partner IT360 on things like IPPs and stuff like that. But if you guys have topics or content you'd like to see more of, just let us know and we'll do our best to develop and tailor our content specific to your needs. But today's session, we're going to be covering 10 tax strategies. Cover them off quickly. There's the low corporate income tax rate, income splitting, income smoothing, tax deferral, home and auto loans, insurance strategies, pension plans, capital gains exemption, although I can't seem to spell that correctly in my slide, and holding companies. So we'll be talking a little bit about what those different strategies are and how you can leverage them to help you pay less tax, which is the goal of many small business owners. And one of the things that makes us unique here at CPA4IT is we like to offer what we call full option accounting. And what I mean by that is we feel it's our job to lay out all the options in front of you from aggressive to conservative and allow you to choose where you fall on that spectrum. We don't do review and audit engagements. We only do what are called notice to reader statements, which effectively means we're providing or filing the information based on what's been provided to us. And we want to file based on your level of risk tolerance. And we also feel it's our job to point out the opportunities that fall into that gray area. And as long as it's not specifically disallowed by the Income Tax Act, we will certainly allow you to be as aggressive as you like. Unfortunately, as a professional accounting firm, we won't allow you to do anything fraudulent or misleading, but there's lots of room between that gray area to that black area where you can't go. So we're going to talk about some of the strategies and some of them in those gray areas today. But first and foremost, we want to talk about the low corporate tax rate. Because the low corporate tax rate is one of the greatest benefits that we have here in Canada. It's not the same in many other countries, particularly, to the south of us, where they don't get nearly the advantages with the LLCs and the S Corp structures that they have, that you have here in Canada. And here in Canada, no matter what province you're in, you're eligible for what's called the small business deduction. And that allows you to have your first $500,000 of small business income taxed at a lower rate. Here in Ontario, that lower rate is only 12.2% compared to the general rate, which goes as high as 38%. Now, the general rate is a little bit more complicated because with the general rate, you also have some federal tax abatements and some other things that reduce that. But the general rate is, like I said, 38% versus the small business deduction rate of only 12.2%. So what that allows us to do is retain money inside of your corporation and pay lower tax than what you would pay to withdraw that out of the corporation. Because if you were to withdraw that out of the corporation, that's going to become income to you in one way, shape, or one form or another. And we'll talk a little bit more about that later. But effectively, you're going to pay more tax in most situations by taking that into personal income than you would by leaving it inside the corporation. Now, there is some basic exemptions, and there is a level of income up to which you'd pay about the same effective tax as if you were to leave that inside the corporation. So we never want to take zero income out of your corporation. But once you're over about $40,000 a year in income, it's going to be more expensive to take that money out into personal income than it would be to leave it in the corporation. And if you're looking at a tax rate, even in the lower income tax brackets of about 30% versus 12.2%, you've got about 18% more dollars to invest and grow and compound that much quicker. So one of the great advantages of being a small business is this low corporate tax rate and the ability to leave that money inside your corporation, have it invested and grow, and be able to take that money out of your corporation tax free. And how we do that, there's lots of strategies we'll talk about in future points of this session. But one of the other important things to be aware of is that if you're looking at alternatives like putting money inside of an RRSP, the other advantage that corporation is going to have is that within the corporation, the income that you earn from investments is taxable, but it's also eligible for capital gains. So if you have a stock and it goes up in value from $100 to $200, you have a capital gain of $100. It's your cost base minus, or your proceeds of disposition, which is what you receive when you sell it, versus your cost base, which is what you bought it for. And so if that were $100, you would actually only pay tax on $50 because you only pay tax on capital gains on half of the gain. In addition, there are some strategies which we will talk about today, like the lifetime capital gains exemption for getting more money out of your corporation tax free. But the base starting point, which everybody gets when you have a corporation, is the low corporate tax rate. And the key to leveraging this is leaving as much money inside your corporation as possible. If you've got money left over at the end of the day, the goal is to leave that inside your corporation. And that's why what a lot of our clients will do is, as you take money out of your corporation throughout the year, we're going to call that a loan from the corporation. And that loan is to pay for expenses on behalf of the corporation, like your home office, your automobile, those types of things. And at the end of the year, we'll look at how much money you took out, and we'll subtract from that the expenses that you paid for with the corporation. And then we will pay a salary based on what the net amount is. And that allows us to keep your salary as low as we possibly can and keep as much money inside the corporation. If you're taking all the money out of your corporation, you are really losing one of the greatest advantages of being a small business here in Ontario, which is having that low corporate tax rate. So in addition to low corporate tax rates, you also have the ability to do tax deferrals. So with a corporation, there are lots of things and strategies that you can do to defer tax. One of the most common is by paying a salary out to your shareholders based on a deferred bonus. So you can defer a bonus up to 181 days from your corporate year-end date. And what that means is, let's say that you've taken $60,000. Well, let's say you've taken $100,000 out of your corporation throughout the, and let's just say that your fiscal year end is July 31st, 2023. And you've taken out $100,000 from August 1st, 2022 to July 31st, 2023. So that salary that we're going to have to declare for you of $100,000 could be salary that we declare in the calendar year 2022, because it could be any time from August until December that we declare that salary. And it would be expensed in the fiscal year, and you would pay taxes on that, based on when you declare it sometime between August and December. You could also declare that anytime between January 1st and July 31st and have that in the 2023 fiscal year. In addition, you can actually even go 181 days from your corporate year-end date, which would actually push you towards the end of January 2024, which effectively means that for people with a July or later year-end, you can push or defer when your income will be taxable to you all the way until a future tax year. So all the way from July 31st, 2023 until January of 2024. And then if you were to pay a bonus in January of 2024, you would have to pay the taxes on that bonus, or what we refer to as source deductions, in early February of 2024. So that's pushing income that you would have in your corporation, giving you an expense that reduces the taxable income. So the corporation's now not paying tax on that. and the individual doesn't have to pay tax all the way until January 2024. And that's just one example of tax deferrals that we can use. There are other strategies that can be done with fixed assets. Many of you may have heard of the ability with electric vehicles that you can expense 100% of the vehicle in the current fiscal year, which is another form of tax deferral. And the reason tax deferral is so important is because of the time value of money. So if you can delay when you pay your taxes, that gives you the ability to have your money working for you, investing and generating income. So whenever we can, the goal and the objective is to defer, is to first minimize taxes, but then secondly, to defer when we're going to pay those taxes as long as we possibly can. And there are a couple of strategies that are available to us, probably the most common of which is the shareholder bonus. One other strategy that we have available to us is income splitting. Now, unfortunately, a few years ago, the lovely Liberals introduced something called TOSI, or tax on split income. And this took away quite a few of our income splitting strategies that we used to have available. Now, it didn't eliminate all of our income splitting strategies, but it has reduced many of them. So basically what these TOSI or tax on split income rules have done is they haven't said that you can't do income splitting with dividends or with salary, but what they have said, if you're doing dividend income splitting, that now there's a punitive tax or this tax on split income that would make it such that there's no tax advantage to doing that income splitting. Because usually the strategy and the reason that we're doing income splitting is to avoid having one individual in a higher tax bracket than the other. So if we can use income splitting to keep two people as equal as possible, we end up paying lower taxes. And that's because of this marginal tax system. Whereas when you go up in different tax brackets, you'll pay higher tax on that new bracket. So if you had one individual paying earning $100,000 in income, that individual would pay more tax than two individuals earning $50,000, because there's more use of the basic exemption as well as more use of the lower tax brackets by splitting between two people. We used to be able to do income splitting through the use of dividends without requiring any active involvement in the business whatsoever. And that was the great advantage of dividends. And we used to do strategies where when kids went off to university, we would give them a dividend from the corporation as long as they were shareholders. And this was a great time to give them income because they had a whole bunch of tax credits that they could use. They also needed the money for school. So it was a very, very effective tax strategy. But when these TOSI rules came in, they actively targeted that group. And they basically said for people between 18 and 24, they had to be actively involved in the business. And there was specific requirements for the number of hours that they were working in the corporation in order to receive a dividend. Now, those same rules don't apply to salary. There are a different set of rules that do apply for a salary. And that is basically that they just have to be reasonable. So that the salary that you're paying to your young children, whether it be for filing, for social media, is still a tax strategy as long as the salary that you're paying them is reasonable and as long as it is a salary. Whereas if you're going the route of a dividend for that 18 to 24 age range, unless they're actively involved in the business, they're going to be subject to this tax on split income. Now, there are still some options for dividend income splitting with spouses. So once the primary shareholder reaches the age of 65, they can do dividend income splitting with their spouse, regardless of how actively involved their spouse is in the business. So that is one of the few exemptions from the TOSI rules. So there are still reasons to do dividends, particularly with spouses. There are still reasons to have spouses and children as shareholders. We also still make children shareholders in many situations because we never know if anything could change down the road. And there are some specific rules, attribution rules that say if you earned a bunch of income while someone wasn't a shareholder, you can't distribute those funds in the form of a dividend to those shareholders, because they didn't earn the income while they were a shareholder. So we want to make those children shareholders and those spouses shareholders generally from the get-go is typically our strategy, even if we don't end up doing any dividend income splitting. Now, as I said earlier, if we can, the more people that we can income split with, the lower the lower the amount of taxes that you're going to pay. First and foremost, every individual has a basic exemption. So there's about $14,000-ish. There's federal and provincial rates, but around $14,000 that you can pay out as salary to your children, and they'll pay very, very little in the way of tax. Now, there are still rules against employing minors. Generally, the minimum age is about 14 before we can do some income splitting with children. There are situations, and again, speaking to that dark gray area or those gray areas of income splitting by employing children as models. Let's just say that that area is a slippery slope from gray to black. But there are some potentials when you do have children that are under 14 to do some income splitting. But each of you would have to weigh the individual pros and cons of doing that and looking at what kind of documentation you could have in place to defend that position. Because when it comes to any of these strategies, probably the most important thing is documentation. And when we're talking about income splitting, that form of documentation is in job descriptions, work instructions, invoices, timesheets, those types of things. So the more documentation you can have, the better. But the one documentation that cannot be recreated post facto is the flow of money. Now, when you're income splitting with a spouse, the flow of money is not as important, but certainly preferred to make sure that we're having a deposit or a payment from the corporation to your spouse. But with your children, that is absolutely imperative, because the CRA will say, well, you and your spouse might have a joint account. That's okay. But with your children, they do need to have their own bank account, and we do need to see the flow of money from the corporation to the children. Now, there's no rules to say that they can't repay you that money for rent or whatever else it is. But what I tend to encourage people to do is teach your kids financial literacy and financial responsibility by giving them an income and giving them the ability to pay for expenses on their own behalf. Because I'm sure many of you are spending way more than $14,000 a year on your children. And if you can find a way to make that a legitimate business expense by having them involved in the business, maybe with social media, with some filing, any of those types of things, it can really go a long way. Let me just clear. I see that there were 2 chats in there, but they were just notifications about earlier. The next thing I want to talk about is the ability to do income smoothing. If I can get there. There we go. Yeah. Okay. So income smoothing is really sort of an umbrella term for a whole bunch of techniques and methods that accountants use in sort of controlling or hedging the effects of high rises or sharp falls in corporate income. And, you know, in the independent contractor world, this probably isn't as critical unless, you know, you're with one of the major banks and they are forcing you to take a sabbatical between contracts, which is quite common. But where we see this a lot is in real estate agents. We have many real estate agents who have their own pracs, personal real estate corporations, and they have income that is a lot more, let's call it volatile, or a lot more peaks and valleys. And so what a corporation allows you to do is to smooth that income. Again, if you were a sole proprietor and you had peaks and valleys in this, you would pay more tax because, again, when we talk about that marginal tax system, just like 2 individuals with a salary of $50,000 pays more tax than one individual making 100,000, 1 year of 100,000 versus 2 years of $50,000, you're going to pay less over 2 years. The exact same sort of methodology and strategies apply. So when we can smooth income over multiple years from a personal tax point of view, we can substantially reduce tax. Now, from a corporate standpoint, again, this can be helpful, not necessarily as critical unless you are exceeding those thresholds of the small business deduction of $500,000. And again, there are strategies that we can use around timing and around specific types of deductions that we can use to reduce and lower corporate income, and as well as reduce and control personal income. So the personal income, some of the strategies that we use are things like a net debit balance, or what's sometimes referred to as a single purpose loan. And in this, what we have the ability is, if you've taken $100,000 out of your corporation to cover your cost of living, maybe because you have a child who's going to get married and you needed to take more money out this year, or you have a parent you're putting into a retirement home and you have to spend more money on that, whatever the case might be, if you have this exceptional circumstance and you've taken a large amount of money, let's say it's even maybe 200,000 instead of the normal $100,000 that you take out, what we're allowed to do is we're allowed to carry a debit balance in the director's advance, which basically means that we're going to pay you a lower salary than the amount of money that you have taken out of the corporation. In effect, you've taken a loan from the corporation. Let's say in this case, you took out 200,000, and let's say we give you a salary of $150,000, and there's $50,000 that you took out of that corporation that you're not taking into salary or income individually. So you're allowed to do that, with the rule that you, in the subsequent year, all of your director's advances have to be paid out. So if in that subsequent year you take out $100,000, then in that year you'd have the 100,000 you took out plus the 50,000 from the preceding loan, and in that year you're not allowed to do a loan. So you can do these loans effectively every other year, but you can only do them every other year, and you can't have a debit balance 2 years in a row. And so what that would mean is that you're now going to have, instead of 1 year of $200,000 of personal income and 1 year of $100,000, you're going to have 2 years of $150,000, allowing us to smooth that income and avoid those higher tax brackets and allow you to pay less tax overall. So that is one of the strategies that we can use. There's also, again, strategies that we can use with things like some of the other things that we're going to talk about today, like pension plans. Some of the other things that we're not going to talk about today, fixed assets and amortization, and some other things that we can do there. So next, I want to talk about another type of loan that we have available, which are home and auto loans. Now, home and auto loans, unlike those single purpose loans that we talked about, you can do anytime that you purchase a home or a car. Now, these can only be done in the years in which you purchase a home or a car. Now, these two loans are actually two very different types of loan. So the first loan we talked about is what's called a shareholder's loan or a director's loan. So that is done because you are a shareholder of the corporation. Home and auto loans are employee loans, and with those come some taxable benefits, which we'll talk about in a second, that go on the employee's T4s. But the criteria for being able to do these home loans and auto loans is that they have to be available to all employees of the corporation. Now, in most of our client situation where they're an owner manager, you're usually the only employee in the business, which is makes it accessible to you as a strategy. There are also prescribed interest rates. So you don't get to decide what the interest rate is that you are that is going to be on this loan. There's a prescribed interest rate by CRA. It's based on the Bank of Canada. It is very reasonable, lower than you're going to get anywhere else in any other bank, but you do have to pay interest on this loan. That interest is going to become the taxable benefit. So while you're paying interest and you're paying back principal on this loan, that is sort of left pocket, right pocket. You're paying yourself, you're lending money to yourself and then you're paying back yourself. So left pocket, right pocket. But because the interest is taxable as an employee benefit on the employee's T4, there is a cost to doing these loans. Now, because you're going to be paying tax, which is a percentage, on interest, which is another percentage, you're talking basis points because it's a percentage of a percentage. And the value that you're going to get out of using these home and auto loans is going to far surpass that cost. And that's because what you're now doing is again deferring or smoothing income. So let's say you want to take money out to buy $100,000 new car. Well, if you were to take that money out of your corporation and buy that vehicle, it would be it would be taxable to you, assuming that it was a personally owned vehicle, not a corporately owned vehicle. And there's a number of reasons why we actually recommend that if you are purchasing a vehicle, it be owned under your own individual name as opposed to through the corporation. I see some questions coming up here. I will get to those in just 1 second, Sam. But yes, so there. I lost my train of thought. I'm just going to answer your questions, Sam, because I lost my train of thought. And I'm going to come back to it. So question popped up here in the chat that says, do sport season tickets qualify as a business expense? There's no definitive yes or no to whether anything, well, there are some definitive no's. There's no definitive yes to whether something is a deductible business expense. But the criteria for whether something is a business expense is one, whether it's reasonable, which is subjective, and two, whether it has the ability to help your business earn income sometime in the future. And then lastly, is it can't be specifically disallowed by the Income Tax Act. So if it's specifically disallowed by the Income Tax Act, you can't claim it. The good news is sporting tickets are not specifically disallowed by the Income Tax Act. Now, generally speaking, if you're giving away sporting tickets to people who might be able to help your business in some way, shape, or form, we could consider that a gift and it would fall under the advertising expense category. If you were going with someone to a sporting event, sort of networking, business relationships, we could call that business promotion, and you'd still be able to deduct that. But under the business promotion category, CRA acknowledges that you're getting a benefit, just like sort of when you go out for a meal or a restaurant, and they add back as taxable income to you half of the cost of that. So if you paid $100 for the sporting event tickets, $50 of it would be taxable. The other $50 of it would not be taxable. So I hope that answers your question. And then getting back to where I was on these specific loans. So yes, you're going to pay some interest on these loans, but it's the interest, the tax on the interest is a small percentage, and the value that you're going to have is, again, if you were going to go out and buy $100,000 vehicle, you would take that money out into income personally and be taxed at that at whatever your marginal tax rate is. So by taking it out in the form of a loan, for example, with a car, we could set up that loan over a period of say 7 years, and instead of taking $100,000, let's actually call it $70,000 for easier math. Instead of taking $70,000 into income in that year in which you purchased the vehicle, you would effectively take $10,000 into income each year, because you don't actually necessarily need to put the money back into the corporation. It would be deemed to have been put back into the corporation by us declaring an additional $10,000 of salary to you. And, cars and even boats and houses all qualify for these, the ability to do these home and auto loans. The only thing to be aware of is it does not work for renovations. You can't take a home loan for a renovation. You can only take it for the purchase of a home or the purchase of a vehicle or the purchase of a boat. And if you are looking at purchasing a boat, it would need to have a bathroom in it in order to qualify and it would actually fall under the home loan, which is important because home loans have longer amortization periods. So you have longer to repay those loans over the time, over time. And the longer that we can stretch out those repayments means the longer the period that we're smoothing the income over, which means the lower the taxes that you'll pay overall. And again, as I said, whenever we can defer taxes, that means that you've got the ability to have that money working for you and generating income, and you've got access to the time value of money. So the other thing that we should talk about are insurance strategies. If I can get my slides to change. And there are a number of different types of insurance strategies available to corporations. Um, so the thing that makes insurance strategies very effective from a tax perspective is that the benefits you receive from an insurance policy are tax free. So when you receive a benefit like a death benefit, it goes into the corporation, goes into a special account called a capital dividend account. Now, there's other things that go into capital dividend accounts, like the tax-free portion of a capital gain. But anything that's in a capital dividend account can flow out to your shareholders as a capital dividend tax-free. So one of the strategies that is often, well, not often, but is sometimes employed is if you have a lot of money inside of your corporation and you're looking for a strategy to get access to that money outside of your corporation without paying a large amount of tax, there is a strategy or a maneuver in which you can take money out of your corporation tax free today by going to a bank, and there's special insurance companies that specialize in doing these. Again, I'm giving you the layman's explanation. If anyone's interested in this, we're happy to introduce you to the insurance professionals who set these up and can give you the more specific details about how these work. But effectively, what happens is you go to the insurance company and you say, "I'd like to set up an insurance policy inside my company." Let's say for a policy of $500,000, and that insurance policy has a partnership with a bank. And that bank will lend you $500,000 using the insurance policy as collateral for that loan. You will then receive that money personally, deposit that into your corporation as a loan from your shareholder, and purchase the life insurance policy with the money the bank has lent you. Because you have deposited money into the corporation, you have lent money to the corporation, you can then take out the $500,000 of your own money that you have sitting in your corporation tax free because it's a repayment of a loan, and you can go out and you can do whatever you like with that, whether that's to do a renovation on a home or pay for your child's wedding or put your father in a retirement home, whatever the case might be. Now the question then becomes, well, what about this loan that I have sitting here with the bank that is, accruing interest? And what about the cost of these life insurance policies? I'm sure they're not free. And no, they're not free. But the insurance policy in theory is invested and growing. And that insurance policy is increasing in value. And at the end, there is a payout on that insurance policy through your capital dividend account. That money comes out of the corporation tax-free, as I said earlier. It is then used to pay off the loan from the bank, which includes the interest and the cost of the insurance policy that has all been paid out of the growth in the insurance policy. And once upon a time, these used to be called 10-8 strategies or 9-7 leveraged insurance agreement. Those don't exist anymore because the CRA basically said you can't have a 10-8 or a 9-7 anymore. And that was specifically because the rate of growth and the cost of borrowing were linked together, a 10-8. So you had a 10% return on the policy and an 8% cost of borrowing. It was guaranteed to increase 2% over your cost of borrowing to cover the cost of the life insurance policies. Government didn't like that because there was no risk there involved. So basically now you can still have these policies, but you can't have the guaranteed rate of return and the guaranteed cost of borrowing. So you are taking on some risk with this, that the policy doesn't grow as quickly as the borrowing cost. But even if it didn't, and you ended up having a cost, odds are that cost would still be substantially lower than the cost of taking that money all out in 1 year and paying personal tax on it. But of course, you really need to speak with an insurance professional, look at what the cost of borrowing is, look at what the growth of the funds would be, and look at what your cost is, as well as a whole bunch of other risk factors that go along with your insurance product that requires actuaries to analyze and develop for you. But if anyone's interested, again, I'm happy to introduce you to the people who specialize in this, because it is a really unique strategy. I was talking to someone at a conference last week, and their mind was blown by this opportunity to get money out of their corporation. And if you've got a specific need to get money out of your corporation, this can be a very, very effective strategy. In addition to the specific maneuver that we talked about, generally speaking, life insurance policies are a great way when we talk about estate planning for passing on money to future generations, because again, that money comes into the capital dividend account tax-free. So it is another strategy for estate planning that you can look at as well, even if you're not going to be borrowing against it to take the money out of your corporation. The other thing we talk about are pension plans. Just trying to get a gauge for how we're doing on time here. Yeah, I think we're doing fine. Pension plans are a very effective strategy for reducing the amount of taxable income a corporation pays. And if you're approaching that small business limit that we talked about earlier, this can be a really effective tool to go and reduce the amount of taxes that you pay. And you can think of a pension plan working very much like an RRSP. Money that you put into the pension plan is an expense to the corporation, which reduces how much tax it pays today. And the pensioner, when he takes the money out of the pension, is taxed on it based on how much he takes in out of the pension when he receives it. So you're again deferring when you're going to pay the tax on this, another tax deferral strategy. In addition, you might be saving tax by potentially moving money that would have been taxed at this higher general rate down to the small business rate by having these additional expenses with this pension plan. And one of the other things that you can do with this is if you're setting up a pension plan for the very first time, you can get credit for past service. So for all the years that you've had your corporation, you can get credit for the past service that your employees have had with your corporation, namely yourselves, to be able to create a large bulk payment into your pension plan. Now, in addition, there are some new rules around pension plans that are actually all in your favor, which one, reduce the cost of setting up and managing these pension plans, which used to be difficult for an owner-managed business and cost prohibitive, no longer the case. In addition, you basically used to have to pick either defined benefit or defined contribution, and whatever you picked, you were effectively stuck in that model. But you now have the ability to basically swap between defined benefit and defined contribution, allowing you to maximize whatever strategy is best for your corporation in that individual year. So lots of things that you can do with pension plans now. And again, if you're interested in learning more about this, that's where IT360 specializes, and they can come in and give you lots more information about these pension plan strategies and how you can leverage them. One of the other things that I like about pension plan strategies is they're creditor proof. They're also one of the few things that if you were ever deemed to be a personal service corporation, CRA can't touch. It's still a legitimate expense or deduction for the corporation, even as a personal service business. So again, if you were concerned at all about that as a strategy, it might be something to consider as a way of sheltering and protecting your hard-earned money. Now, nearing the end here, we've only got about two more strategies. This one is the capital gains exemption. So many of you may have heard of this before and realize that every individual has a lifetime capital gains exemption. It's over $800,000 per shareholder of the corporation, and that could actually even be multiplied with family trusts, and usually it's one of the only reasons people use family trusts these days, as well as some form of estate planning, which gives the owners of the trust control over the estate after they pass. But the lifetime capital gains exemption means that if you sell shares of your business and you are able to invoke the lifetime capital gains exemption, you will be capital gains exempt from $883,000 of income. And that's actually indexed to inflation, so it goes up every single year. Now, that doesn't mean that if you that let me step back here for a second. As we talked about earlier, when you have a capital gain, you only pay tax on half of it. So if you had a capital gain of $1 million, you would be taxed on $500,000. That doesn't mean the lifetime capital gains of 800,000 comes out of the taxable portion, the 500,000. It comes out of the total capital gain. So if you had a capital gain of $1 million and you had a lifetime capital gains of 800 for easy math, then you would have $200,000 of a remaining capital gain on which you'd pay tax on $100,000. But still, that's $800,000 per shareholder of the corporation. And as well can be multiplied with other family members by leveraging trusts. Now, there are two main rules for being able to invoke a lifetime capital gains exemption. Well, actually three. The two specific rules are the shares must have been owned by you for 24 months. So you can't have just bought a company a year ago and then try and sell it again in a year and get the lifetime capital gains exemption. You have to have owned the shares by you and no one else for 24 months. In addition, all or substantially all of the assets of the corporation must be used for active business, not for investing. And there are ways to purify a corporation. So if you're ever considering selling your company, you want to make sure that you talk with a financial professional to see if your corporation is going to qualify for the lifetime capital gains exemption. And if not, what you need to do to purify it so that it can. Now, the third criteria is not a specific criteria of CRA, but it is a very real world criteria. And that is that you have to be selling shares of your business in order to qualify for a lifetime capital gain. Now, the reality is not all sales of companies are sales of shares. Many of them are sales of assets, because a buyer, in fact, usually doesn't want to buy the shares of a corporation. They would rather buy the assets, the goodwill, the intellectual property, the client list, those types of things. They'd rather own those as assets rather than purchase shares of the corporation, because when you purchase shares of the corporation, you take on all the liability that has accrued with that corporation that existed, regardless of whether you were aware of it or not. And so that just simply means that there's more risk for the buyer when they are buying shares rather than assets. So people will, even if they're willing to buy shares, they're going to pay less in the acquisition than what they would pay if they would buy assets. So that's a very real thing that you have to be aware of when you're trying to leverage getting the lifetime capital gains exemption. But if leveraged effectively, it is a great way to exit from your corporation very tax effectively. Now, lastly, we want to talk about holding companies. Holding companies are one of the ways that we purify corporations for lifetime capital gains exemption. It's also one of the strategies that we use to help make sure that you're maximizing the small business deduction. It is also one of the strategies that we use to reduce the total overall taxes. So when we started this session today, we talked about the small business tax rate being only 12.2% here in Ontario, and that there's a general rate of 38%. Well, investment income is one of the types of income that is subject to that general rate. So if you have any form of passive or investment income, that is taxed at a higher rate than your small business income. And it gets even more complicated because there is capital gains, which, as we said earlier, you only pay tax on half of it, but it's tax on half of it, but then at the 38%. There are dividends, which are a special type of tax that you pay tax on at the 38%, but it goes into a refundable pool called RDTOH or ERDTOH, which is recoverable dividend tax on hand or eligible recoverable dividend tax on hand. What this simply means is any tax that you're paying on a dividend, you're eligible to get 100% of that tax back if and when you pay a dividend to your shareholders. And then there's also interest income, which is taxed differently. Again, interest income, arguably the worst type of income inside of a corporation, because it's not a refundable tax. It's also taxed at 100%. So if you have $100 of interest income, you pay tax on 100% at the general rate. So one of the strategies that we use to move money that would be taxed at this general rate over to the small business rate is by leveraging a holding company. First, if you have just an operating company, but you've got some investments in there, you can take expenses that you have and reduce the investment income, but only after you have eliminated all the active business income. So let's say that you have, $80,000 worth of consulting income and $20,000 worth of investment income. And you had $100,000 worth of expenses. Well, you're fine because, you're going to not pay tax on the 80 because you've got more expenses than you do income. You're also not going to pay tax on the 20 because you have $100,000. You have more expenses than your total income. Now that's excluding dividends, which unfortunately are taxed regardless of what income you have because it's a recoverable tax. But now let's take another scenario where you have $120,000. You have $80,000 of consulting income and $40,000 of investment income. So the first $80,000 of deductions goes against the operating income first, and then you've got $20,000 to apply against the 40. You'd still pay tax on $20,000. Now, if you had a corporation that was structured with a holding company and an operating company, and that holding company had $40,000 worth of investment income, and the operating company had $80,000 worth of income, what we would do is, let's say 50,000 of that 100,000 expenses was salary that you were paying to directors or shareholders of the corporation. What we would do is, instead of deducting that $50,000 as salary in the operating income in the operating company with the $80,000 of profit, we would take that and deduct that in the holding company that has $40,000 of profit and now has a loss of 10,000. And in fact, what we probably do is only take 40 of that in that company and 10 from the other company. So we end up with two T4s from two companies, 40 in one, and that company pays zero tax because it's got zero net income. Now your operating company now has 80,000 minus the 50 minus the 10. It's still got $20,000 of taxable income, but it's taxable income at the 12.2%. So that's one of the things that a corporation, a holding company can do for you. It can also provide a form of asset protection because it's a separate legal entity and it's a way of sheltering and protecting your hard-earned money. It can also help you avoid another lovely thing the Liberals did for us, which is the erosion of the small business deduction limit. So if you have more than $50,000 of passive income, it will begin to erode the amount of small business deduction limit that you have. And for every dollar over $50,000, it erodes your small business deduction limit by $5. So let's say that you have $100,000 of net passive income, and it's based on the net, not the gross. So net is revenue minus expenses gives you your net. Gross is just your revenue. So it's based on your net income. Let's say you had $100,000 of net investment income. That would be multiplied by 5, which is $250,000. You would subtract that from your small business deduction limit, which is $500,000. So now anything over $250,000 of net income to your corporation would be taxed at that general rate. So again, having a separate holding company allows us to manipulate and control that net income of that corporation by picking and choosing where we disclose and pay salaries at it. So those are, just a few of the many tax strategies that we have available in our quiver to help you pay less tax. Some of these are available, will make sense for some of you. Some of them won't. Obviously, what I recommend is that you don't try to take advantage of any of these strategies without speaking with your financial advisor or your accountant or both to make sure that your plan and your strategy makes sense. Because as an accounting firm, the best thing we can do is be proactive in the strategy and the plan that we build for you, because the more proactive that we are, the more foreshadowing that we have, the better of a financial plan that we can put together for you. So I hope you guys found this session helpful. I am going to open it up. We've got a few more minutes here before I need to wrap. So I'll open it up for a Q&A. If anyone has any questions, feel free to post them in the chat. If not, I'll let us wrap a few minutes early here. And thank you guys for taking time out of your busy schedule to join us. And again, I don't see anything popping up yet. I will give it just a few more minutes as I begin to shut down our live stream here on Facebook. If I can find that. There we are. So let's end that. So bye everyone on Facebook. Oh, we do have some questions. Oh, we got a couple questions come in. Maybe I'll let you hear these ones. Well, first one is just a thank you. You're more than welcome. Thank you for coming out. The other one is, can you elaborate more on buying an electric car using a loan? Okay. So sure, there are there's some new advantages for electric vehicles, some additional abilities to claim deductions that you don't have. You can amortize more, you can amortize faster. When you purchase an electric vehicle, you have to decide whether you are purchasing that in your corporation or under your personal name. If you are buying the electric vehicle under your personal name, then you could take the money out of your corporation, and instead of having to pay tax on the money you take out of your corporation to purchase your vehicle, you could take that money out of your corporation, call it a loan, and you would repay that loan over 7 years, instead of having it all to be taxable income into you in the first year. What you would end up in a situation like that, because of the accelerated depreciation methods, in your very first year, you'd probably end up with substantially more expenses than you have to take into income for your loan. But in subsequent years, you'd have to take, some income to repay that loan or cover that loan. So I don't know, hopefully that answers your question. But this home loan strategy and auto loan strategy, they're not just available for electric vehicles. They can be used for any type of vehicle whatsoever, but they only apply when you're purchasing the vehicle under your personal name. So if it's a corporate owned vehicle, a corporate asset, which again, I said earlier, we don't tend to recommend, you wouldn't use a loan. But if you're purchasing a vehicle outside of your corporation, you can use the auto loan strategy to do that. And then, like I said, each year, let's say the car's $70,000. If you weren't using a home loan, you'd have to pay tax on $70,000 that you took out of your corporation because it would become income to you. But with this home loan, effectively, instead of us giving you $10,000 a year, or instead of $70,000 in 1 year, it would be $10,000 plus the interest each year into income to you over 7 years. Okay. We got some Facebook questions here. What is the best thing to do with excess money unused in the business? Invest it. So leaving it inside your corporation and investing that. Once you reach a certain threshold, you want to look at setting up a holding company to manage those investments. Those investments can be stocks, they can be GICs, they can be real estate, they can be whatever you want to invest in. But the key is leaving that inside your corporation and getting that to generate income for you in some way, shape, or form. At what income amount would it make the most amount of sense for a sole proprietor to incorporate? Great question. So it's a question we get a lot, and there is unfortunately no real magic number at which you can say, oh, this is the number, because it's based on how much money that you are leaving inside, or how much money you have the ability to leave inside your corporation. Because as a sole proprietor, you're going to pay tax on whatever income that you earn. Yes, you can deduct expenses, which reduces the taxable income, but whatever's left over at those expenses is taxable at whatever your marginal tax rate is. Inside of a corporation, you have the ability to choose how much of the money you have left over after your business expenses that you leave in the company and that you take out as salary. If you're the type of person who spends every single dollar that you earn, no matter how much that is, a corporation isn't going to provide the same value as someone who earns a lower amount of money, but is a really good saver and is able to leave that money inside the corporation. So the key is leaving money inside your corporation. If you can leave more than $10,000 a year in your corporation as retained earnings or net income, the tax savings on that are going to exceed the costs of having an accountant to file the tax returns and do all the compliance requirements that go along with having a corporation. Because the only downside to having a corporation is that there is a cost of maintenance associated with it. It's a more complex tax return than an individual tax return, even a sole proprietorship. And you will pay more to have the accounting services for a corporation than you would for a sole proprietor. Okay. And then we have one more. At what income amount would it make the most sense? Same question. As someone's on both. So I think I've answered that. So I think are done with 2 minutes to spare before my next meeting. Again, one more. Oh, another thank you. You're welcome. So thanks again, everyone, for joining us on today's session. And don't forget, we have more webinars every month. So go check out the events section of cpa4it.ca. Don't forget to follow us on social, sign up for our newsletter. We got lots of great content that we continue to share with you each and every month. So thanks again for joining us, and we'll see you soon. Bye for now.